First of all, I'm so excited that you're joining us today. We have a special guest who is a little bit of an in-bed. It is Barry Ritholtz. Hello, Barry. What's your official title these days? CEO?
Chairman and Chief Investment Officer.
Chairman of Ritholtz Wealth Management. That's amazing because it's the same name as your last name.
You know, these coincidences pop up sometimes.
All right, so this is going to be tough for you because you're a yacker and you know that I'm controlling the show, right?
You're a yacker also,
Totally.
so I will defer to your yackage.
Thank you. We have a shared, it's like from the same shtetl.
Right.
You know, we come to this place very honestly. Barry, a lot of the people that I talk to in my world may not know who you are, so I'm going to do a little bit of a backgrounder. So,
Fire away.
You were born where?
Brooklyn.
And
despite having no accent whatsoever.
No, none.
That's where I was born, Brooklyn, Williamsburg, New Jersey for a couple of years, Long Island, New York City.
And how'd you get into this business?
By accident.
Tell
Totally
us
by
more.
accident. Undergraduate, applied math and physics.
Hold on, stop a second.
Yeah.
Applied math and physics.
Yeah.
What were you thinking at that point? Like, what did your parents do?
My dad was a placement officer originally for scientists, engineers, back when people would go to third parties to get jobs.
Okay.
Like he did that, and just always good in math and science. I assumed engineering was my path. By the time I'm a junior in college, I realized, hey, I was pretty good at this in high school and not bad at it in college. But those guys, they're really good, and I can't keep up with them.
Isn't it interesting when you go to college and you have some sort of comeuppance when you were a golden child in some way?
Big
shape, or
fish,
form?
little ponds?
Yeah, it's awesome because it's like that moment where you kind of look around and say, these people are phenomenal. I had that on the soccer field.
Right.
So when I went to college and I saw these young women who were not just skilled, not just in great shape, not fast as hell, but like had the whole package together. And I literally looked around and I said, I'm in big trouble here. So, I ain't the star no more.
That's really funny. You know, everybody is working within a little market. And as that market gets bigger and bigger, suddenly you realize you go from, hey, I'm the fastest guy on the track team to, oh, those guys are really fast, to, I'm an amateur. Those people are amazing.
Exactly.
And that's how, you know, stars are found.
So you're not going to be an engineer. You're coming out of college. So what are you going to do?
I have no idea. And, you know, if you're out of college and you're a Jewish kid from Long Island and you don't know what you want to do, the default is almost go to law school.
Yes, of course.
Right?
My mother's so disappointed I never went.
Right? And my mom is like, you have to do something. What are you going to do? And I was working. I had a job. I worked all through college. I put myself through college. I put myself through law school. I found that I loved law school. I loved the intellectual challenge of that sort of problem solving. I hated that so much was dependent on either a judge or a jury. Like, wait, I don't know what the judge had for breakfast that day. I don't know if he's hungry and cranky or if his team lost over the weekend and my client's going to get screwed. By the way, all those things are actually true. Sentencing is, you don't want to be the last person to
Yeah, but you didn't have to be a litigator. You could have been a corporate lawyer doing M&A.
I started out as a corporate lawyer, tedious. Like the blog is called The Big Picture because it's not called picayune tedious details that I have no interest in. And so I had a client that was the predecessor firm to E-Trade.
Okay.
And I was out in their office one day and I get a tour of the trading room and I'm just fascinated.
This is out in the Bay Area?
This is before they close. So not long after I start at the firm that was the predecessor to E-Trade.
Which is what was the name of that firm?
It's
All right.
27.
Good old what's his name?
I worked for a couple of guys, one of whom goes on to be very senior at E-Trade and then launches Marty Averbach launches ISE, which was bought not too long ago for a few $1 billion by Deutsche Börse. I'm still friendly with Marty, lives like a half hour from me. And I work for these guys. I start as a trader.
Yeah.
And was unable to go. The guys who went to California did really well when E-Trade closed all their regional offices, rebrand, and roll out as essentially the first online trading shop. I want to say that was like 96 or 97.
So
like
you're
way
working,
back
but when you're
when.
working as a trader, what were you trading? Stocks?
So you're trading off flow of the whatever orders are coming into the office. Plus, you have a certain amount of discretion where you can trade for as many minutes, hours, days as your buying power allows you. And so you're just trading equities. Whatever's moving, you have a holding period. It could be seconds. It could be minutes. We set up a couple of really interesting algorithms because back then, Instinet was a different system than NASDAQ, was a different system than SOS. And you would see price differences. Wait, this is $10 on NASDAQ level 3, but you can buy it for $9.75 on Instinet, and you could sell it for 10 and a quarter.
Like
on
it was
SOS.
just very easy arbitrage in some respects.
For a while until
right?
the big guys figured out with big iron, high horsepower programming and a lot of IQ points, they figured out how to capture all that. Every inefficiency in the market eventually gets arbitraged away because the people with the capital, the know-how, the more I spent time on a trading desk, the more I learned about how the advantages of being a longer-term investor.
Okay, so were you a good trader or not so good trader?
Depends on the month. Some months I was great.
Yep.
Probably some months less so.
Okay.
The thing I will self-identify as something that I was very, very good at, which is kind of unusual because it's very counter to the rest of my personality, was I was very aware of how much I loved finding that vein and hitting it with the dopamine thrill of making a trade. And by the way, not even a good trade, just like so exciting to be in the mix of it. And when you make a winning trade, oh, what a thrill. And my greatest insight was, dude, you're not doing this for P&L. You're doing this for shits and giggles, for thrills. You should be aware of that sensation, which is not disciplined, not focused on profitability. But, on Tuesday nights, we would take the quote server and take it offline after the market closed and everybody submitted their P&L for the day, which literally we would save to a 3.5 floppy and walk into the head trader's office. We used to call that sneaker net. You would literally walk it in. And then we would take the quote server and turn it into a Quake server, which was one of the first multiplayer games. And you just get lost in it. You play for hours against all the other traders. And at a certain point in the Quake experience, I'm like, this is the same thing as trading. I'm doing it for fun, not P&L. And that, I want to say late 96 or so, is what sent me down the rabbit hole of behavioral finance. Why do we make decisions? Why is the guy next to me doing great when the guy on the side is getting killed? And then next month, he's doing great and he's getting shellacked every day.
Yep.
And everybody is more or less reading the same thing, doing the same things. Why the wide dispersion in outcomes? And it comes down to all of these behavioral things. So before Kahneman won the Nobel in, 2002, I had been reading people like Cialdini, Gilovich, who wrote a book, the first half of which is just pure behavioral finance, How We Know It Isn't So. And back then, it wasn't like Google Scholar existed and you could get any published paper. You would have to go to the library and say, I'm looking for this, and they would either have it or they would say, oh, you have to go to Stony Brook Library or NYU, their library will have this paper.
So you, a lawyer, a trader, and how did you make the leap from trader into investment advisory business?
I had a very lucky trade that made a bunch of money that could have gone the other way. Somebody announced something, a takeover. I went wildly over on CNBC. I went wildly over, and then the stock is halted, and all of a sudden I have way more stock than I should have. And after the stock reopened for news pending, the deal went through. I think that was WorldCom MCI, And it was,
So
I was
this is
on
99?
the right, something like that, 98, 99. And it was pretty clear to me that, hey, this worked out, but it was dumb luck. There was no skill involved. This could have just as easily gone the other way. And then I didn't have $5 million if it went the other way. That wasn't going to happen. So it was kind of a wake-up call in addition to that self-awareness that, hey, you're doing this for fun and not for P&L. And so I started looking for something in the world of research where, so along the same timeline, I am especially, disorganized, always attracted to shiny objects and just all over the place. And I'm self-aware of that. So every day before the trading day opens, here's my list, which I would tape to my big old monitor back before there were flat screens, my big CRT. Here are the economic reports that are coming out. Here's the consensus. Here's what I think is going to happen. Here are the earning reports. Here are the stocks that are trending. Here's what's above or below their, what's changed above their 50-day moving. Like I'd have a whole list of stuff. And it was a page or two of stuff. And these are the 5. I wouldn't read the paper. I would skim the paper, the Wall Street Journal, the Times, the Washington Post on the way into work. And I would just figure out which stories I wanted to read later. I learned never to read stuff before the trading day.
But this is still in your
head.
predecessor to E-Trade. You're still there?
No, this is as a trader. This is me working as a trader.
Okay.
And I would just tape that list to my monitor. And that list, first it got Xeroxed. By the way, listen to the anachronisms in this paragraph. It would get Xeroxed and shared around the office.
Or wait a minute, you didn't say mimeograph, which would put us into a different era.
That was when I was in high school.
Yeah, exactly.
It would get Xeroxed and shared around the office. Then later it would get faxed to other offices. And finally I'm like, all right, if people want this, I'll put it on an email list. So that was getting emailed. And then late 98, something like that, 98, 99, I started putting it up on GeoCities.
Right.
Which was pure HTML, how to teach myself how to do that. And GeoCities eventually became, in 2003, I moved from GeoCities to TypePad. 6 Apart was a software company. I was a beta tester for them.
Okay.
I was a beta tester for Google. Hey, do you guys need some money? I'd love to invest in you. I got a very amusing, thanks, we're good.
We're all
email
set.
Back from
Great.
me. And then WordPress in 2008, and I've been on WordPress, ever since.
So what I'm trying to understand is as I'm thinking about your career and I'm looking back and I'm trying to say applied math physics guy who
switched third-year school to poli-sci and philosophy.
Okay, I get that. So you find the passion in the liberal arts.
Not really,
but
just like tired of work, like physics is labs and applied math.
It's hard.
There's like homework.
It's hard.
You can't just kind of walk in and skip.
But you also have like an emotional body. You're aware of yourself. You're self-aware, which is
on occasion, most of the time oblivious, but occasionally insightful.
You understood that there was something about how your DNA that made you somewhat susceptible to being kind of hooked on the high of trading.
Human.
Right? Yeah. And then you kind of say, wait a minute, let me think about things more holistically, right? So now we have the economic reports and the data, how you sort of see the world. And now you write about it. And you're a good writer and you get press and you are enamored with that as well. Where does the idea of how can I apply this to regular people, where does that come in?
Let me figure out how to explain this. So I get offered a job as the assistant researcher to the head of research for a firm. Back then it was Prime Charter. Eventually they become Oppenheimer. And the guy I worked for, Larry Hart, was a former, I almost said Lucent, AT&T Labs, Bell Labs.
Yeah, sure.
He was a software programmer for them and then eventually became an analyst at covering technology. This was like the last, the last part of his career. And I was his researcher, and he's like a real hardcore geek. And my skill set is, all right, I have enough, science that I can understand, his technical jargon, and I can translate it into English for the brokers. That they were a stock brokerage, Prime Charter.
Okay.
And so I remember pretty early on, and I'm sure I'm getting these dates somewhat mixed up. AOL was like $6 or $7. Hey, this is the on-ramp to the internet for the average American. So I had to take all of Larry's jargon and translate it into English. And then the other big thing I wrote up for these guys was, in fact, one of the senior brokers had come over and said, listen, Barry, we love Larry Hart, but no one understands a f***ing word this guy says.
Bleep that for my show.
All right. Nobody understands a damn word this guy says. Can you just pick a couple of his stocks and turn it into English so our guys can explain it to their clients? Sure. So AOL, on-ramp to the internet, and then EMC, every credit card transaction, every option trade, Big Iron has to store all these digital transactions.
Yep.
They're the ones, I think EMC at the time was $7.
Massachusetts-based company.
Yep. Now part of VMware. I think Michael Dell owns some or most of it. So anyway, I did that. I went from there to another firm. I ended up at Maxim Group, which was a broker-dealer with a syndicate desk and a lot of brokers, and became their strategist. And what was probably that was August 2002, what was probably the single best, luckiest break of my entire career is Ed Rose was general counsel at Maxim Group. And I'm writing on GeoCities. I'm moving this over to TypePad. And one day, and every Monday, I'm doing the Monday meeting with there was a team of like 4 different people. Fixed income would say this, syndicate would say this, the head of brokers would say that. Barry will give us a few words about the market and the economy. And I would get questions all the time. What was that about this? And can you so I just started posting all that on the website. And to my great fortune, Ed Rose pulls me into his office and says, listen, I'm okay with you sharing all that stuff online. I understand what you're trying to do. So I know people are, the joke was brokers would say, what's the stock symbol for EMC? And they weren't kidding. They were serious about it. But so in order to avoid that, everything would go up online. And Ed, to his credit and my great fortune, said, look, you could put all that stuff up. You don't need legal or compliance pre-approval. The caveat is no buy or sell recommendations.
Okay.
If you want to talk about Walmart as indicative of the retail sector or you can mention them, but you can't say buy this, sell that.
Right.
I'm like, I'm really not doing that anyway.
Okay.
There's no glory in that.
Yep.
If you're right, the guy who followed your advice is a genius. And if you're wrong, that Ritholtz is an idiot.
Right.
So I've learned cocktail party chatter. Someone wants to talk to you about a stock. No upside. There's just no reason to say like it, don't like it. Because if that's just back to behavioral finance.
Yeah.
Humans love to take credit for any human being thinks that they're doing well because they're moral, they're ethical, they're hardworking. That other guy is doing poorly because he doesn't deserve to do well. And by the way, when we're doing poorly, it's because we're unlucky.
Yeah.
And when that guy is doing well, he just hit the lottery.
Yeah.
And so the same thing is true of stock picks.
Okay, but so get me from 2002 to 2008. What's happening in those years of expansion, recovery from the dot-com boom and bust? What's happening in the life of Barry?
So market makes a low October 2002 and March 2003, and I'm writing about this, saying, hey, anytime you see, I'm a buyer anytime a stock market, like the U.S. stock market, is cut in half. NASDAQ down 82% peak to trough. You want to own this. And so I'm trying to explain while I'm doing research and using, here's where law school is really helpful. Lawyers are generalists. You have to be able to argue every case. You don't know which part of, even if you're in, white collar crime. There's a million subjects in white collar crime.
Yeah.
So you have to learn the area, learn the history, be able to talk about it intelligently. And with finance, you have to be able to talk about the math of it a little bit. And my secret sauce was I brought in a little of the behavioral finance to it. Hey, let me explain why you're doing this wrong. Let's explain why you're doing this wrong and why your brain is working against you.
Okay.
And so I start writing about this subject. It's on TypePad. for a good couple of years, and it starts getting picked up. I'm quoted in the Journal. I'm quoted in Barron's.
Now, how did that feel when that first started happening? Quite a validation, right?
Yes, there's a yes, but. I'll come to the but in a little bit. I come back from being away for the weekend, and back in the day when you would walk into your house and the message machine would say 43 messages. What the hell is this about? All these calls out of the blue. Dude, Kudlow mentioned you on the show on Friday. There was a quote in the Wall Street Journal. Maybe this was like late 2002. And I said, hey, not only does it feel like the market's bottomed, but there's a sense the train is leaving the station and investors want to get on board. And Kudlow read, that's a Wall Street Journal quote from me. Kudlow reads it on the air. And so I write him just a polite note. Hey, thanks. I got a ton of radio silence. A few weeks later, he says something. Now I'm watching the show a little more carefully. He says something, and I'm like, oh, I just wrote about that last week. I send the piece in, radio silence. Like, all right, they're busy. The third time it happens, an email comes back. Hey, get this guy in the show. He seems to know what he's talking about. So I start doing the show, and I do the show. It started out once a month, and then it was twice a month, and it was once a week.
Okay, wait a second. Hold on a second. So are you you're done? Are you still head of research at this place, or are you
I'm
just
chief market strategist at Maxim Group?
Okay, and you still have that title. And are they paying you to go on CNBC, or are you just showing up as a guest?
No, I'm a guest. They want me to go. They want me to get the firm's name out.
And Maxim's happy is because your name is out there. That's awesome.
The first day I do the show, I walk into the boardroom the next day. Round of applause, standing O. It's like, wow.
All right.
Because everybody wants to have social proof and credibility. And to people selling a product, as I've learned over the years, that social proof is valuable.
So that happens all through the 2000s. Life is good. Where are you so let's go to the beginning of 2007. What are you doing for work? What's going on with the blog? Where are you appearing on TV?
Right.
We are starting. I only know this because just these dates for people like you and me are sort of seared into our head.
Right, substantial.
Right? So, March of 2007, Bear Stearns has 2 hedge funds that go broke. It's like the canary in the coal mine, right?
So 3 things are going on at that time. First, I've been writing and jumping up and down and screaming about subprime and derivatives and housing. And I told you what my dad did. My mom was a real estate agent, so I probably focused more on real estate than the average person on Wall Street. And I had 3 charts that I showed over and over and over again. Median price of income to median price of house. For 100 years, it's like this. Then it's 3 standard deviations above normal. Cost of ownership versus cost of renting. Same thing.
Yep.
And the last is the value of all the housing in America versus GDP. Same thing. Like all 3 charts. And it's like, hey, either everybody's salary is going to double or stocks are going to come down appreciably. And I read this white paper by Reinhardt and Rogoff that looked at 5 crises.
Yeah.
I never can remember which ones they were. It was Mexico, U.S. in 29, Japan, Finland. The 5th one always escapes me. Anyway, the average the average damage during a financial crisis, markets drop 40 to 50%, but housing drops 30%. And if you recall, in the mid-2000s, there was a lot of chatter. Housing prices never go down.
I know. Can I tell you? Which,
by the way, if you lived in New York in the 80s and 90s, that was nonsense.
Baloney. I remember this was because I was the chief investment officer of my RIA at the time. And I remember in 2007 that a guy said to me, well, based on our models, we're really comfortable with these positions. Right. And I said, your models are not right. I'll tell you that right now. Like, there's no way that that's right, that you're going to, nothing ever happens, therefore it never happens. That's baloney. And it's funny that you should mention that because during the COVID crisis, for a piece that we did on CBS Sunday Morning, I had Ken Rogoff on. And I asked him, how does this compare to your financial crises, right? So it's Carmen Reinhardt and Ken Rogoff who wrote who wrote this pretty seminal book that is very impressionable.
Based on that paper, the book was 800 years of financial folly.
Right, and it was
this time is different.
Right. And he said, this time is different because, as always, we know we've never been through a once in a century pandemic.
Right.
He said, but the result of going through this pandemic and these other crises is that what we can tell you is that it is going to resolve. We just don't know how. And you see, he's like, I'm an economist, so I can tell you it will be okay. I just don't know when, and you might feel a ton of pain between now and then. And I thought that was his take being interesting, which is like he's sort of a historian also. Like
he's very much a historian.
Right? And so
literally the subtitle is 800 Years of Financial Folly.
And from his point of view, like the difference of this crisis, the pandemic crisis, and say, because I would say, how does this compare to the financial crisis? He said, well, it's not really the financial institutions that are coming into this period. Right. And that came into this period doing bad stuff. It is like, we're all in this together. We're all going to get out of this together. We don't know how it's going to,
Well, most of us. Some of us didn't make it.
Exactly. Financially, not physically. But I do think there's something to be said for looking back in time and saying, of course it's not going to be repeating, stanza for stanza. We're not going to have that. But the idea that history doesn't repeat itself, but it does rhyme, that we do have a way that you could look back with your charts and you could say, there's something wrong here, there's something different. And also the idea that the industry was so in love with its position that it was so hard to break through.
Myopic.
It was so difficult to have a conversation with someone who is embedded in the ideology that, no, we have actually created products that are not subject to the same kind of risk.
Right.
And old farts like us are like, isn't it the same thing? It's just borrowing a lot of money to do shit.
The line I used to use on people when someone would say, well, our models don't allow for house prices to go down. I like to look, we're not even talking about 1929. You just had to go to 1989 to know that home prices dropped. George Box, the professor of statistics out of the UK. All models are wrong, but some are useful. And a model is just an artificial depiction of the universe. And if, you're off by a little bit, well, in the real world, it's going to be off by a lot. So I mentioned, so that was one thing. I've been writing about that. The second thing of three things that happened is I read that white paper on 5 crises, and I kind of say to myself, hold the stock market part aside. Let's think about if real estate that supposedly can't lose value drops 30%, what would that mean for the market? And I didn't have the patience to do all 500 stocks in the Dow, but I said, let's reverse. And at the time, I'm publishing at thestreet.com.
Okay.
Let's reverse engineer the Dow and figure out that if real estate drops 30%, what will this mean for the banks, for the consumer companies? And let's be blunt, there's a lot of spitballing. You're kind of ballparking things. At the time, the Dow was approaching 13,000, and I reverse engineer a number of 9,800, but say, and here's where the behavioral finance comes in, hey, if we drop from 13,000 through 10,000, I think that causes a 3,000-point panic. And I think we end up around 6,800. This isn't a forecast. It's not a prediction. The only time that's mentioned is in like the last paragraph. I think there was 2 or 3 serialized in 3 sections. Nobody wanted to talk about the analysis. They didn't want to talk about Reinhardt and Rogoff. They didn't want to talk about real estate.
6,800.
That's all anyone wanted to talk about.
Wasn't it 6547 was the bottom?
61 and change on the Dow.
All right. Fact check that, guys.
So I get invited to do the annual Business Week forecast. And I say, listen, I think this is, by the way, this is like late 06. Listen, I spent a lot of time studying forecasts and analysis, and all these forecasters are terrible. They're all wrong. A year is way too long. You want to forecast out a few weeks? Okay. You want to forecast out a decade? You have a trend. A year is long enough for random events to happen, right? And my current favorite events is nobody was forecasting the invasion of Ukraine.
Yeah.
Right before that, certainly nobody in 2019 was forecasting a global pandemic. And last year, no one was forecasting, the whole Israel-Gaza war. So events are a year's too long a period to really make a reliable forecast. And after, I'm explaining this to the editor of Business Week, and I'm like, let's do some counter-programming and talk about why forecast is folly, which was a column I had written, and why all these things are unreliable and investors shouldn't base their portfolios on it. And I'll never forget, the answer comes back, and this was before Bloomberg owned them, so I could say this without anybody calling me up and yelling at me. Listen, it's a big double issue. We sell a shit ton of advertising. Do you want to be in it or not? And I was like kind of offended by that.
Yeah.
So I'm like, sure, here's my number. 6,800 on the Dow.
Yeah.
And whatever the proportionate numbers, I think it was like 720 on the S&P. I don't remember what the NASDAQ was, but it was like a 50%. Wherever they were, they're pretty much in half. And so the numbers come out, and there's this giant cluster over here, and then down around the floor is Barry. And Kudlow immediately says, let's get you on the show, and proceeds to just excoriate me. Why? And I explain, listen, it's not a forecast. It's sort of a, we're sort of wargaming what happens when, not if, when housing suffers its setback, which had already begun. So housing peaked in 06. By 07, it's already rolling over. And for about a year, I absolutely, the wrong type of goat. And I remember walking back from a hit on CNBC in the Madison Avenue studio with Peter Bookvar, whose office was not too far from our office. And I'm walking back, and we both talk about the risk from derivatives and the risk to subprime mortgages. And this is 07, and the market's still going higher.
Yes.
And I wasn't saying, hey, sell everything now. I was saying, when this rally ends, look out below. The anchors laughed at us. I'm not exaggerating. They LOL out loud on TV at us. And we're walking back from that. And I'm like, hey, either we're hallucinating and wrong, or everybody's in for a really big surprise. Like the consensus that it wasn't that I don't agree with your analysis and here's the reasons why I think your fundamental premise is flawed. It was just, you guys are crazy. That can never happen. It was hodlers to the moon before that even existed.
And so, of course, you're proven right. But now I want to know, how is it?
Proven right in a weird way.
Well,
I'm on vacation. My wife is a teacher. We can only go on vacation on school holidays.
Okay.
When I'm away, we go through Dow 6,800. And I had said to a buddy a few months beforehand, when we broke 10,000, hey, if we get anywhere near 6,800, don't let me be that. Can we curse here? I'm not sure.
Not so much.
Not so much. Don't let me be that putz who doubles down and says 3,400, right? Like, I want you to slap me upside my head if I do that. So I get home from vacation, and of course you're like exhausted. And that Monday I get a phone call. This is your reminder. You told me if we got anywhere near it. And I'm like, I'm halfway done writing this up. So I write up a piece, cover your shorts and go long. We're looking for the mother of all bear market rallies. Out that goes. Immediate phone call from Henry Blodgett, a Business Insider, and Yahoo. Hey, you want to come on TV and talk about this? You've been the biggest bear on Wall Street. Let's go. So I go on TV and say, look, every indicator we look at is pinned as like, remember the old VU meters? That's where us oldsters, like kids don't know that.
Yeah,
everything is pinned in the red. Like down 50% is a great entry point, but I've just never seen this level of bearishness either in my experience or in the history books. You got to buy him here. And I went from this guy's always bearish, what an idiot. The tragedy of Yahoo is all the comments are gone. And to this guy's a permabull, he doesn't know what he's talking about.
So we're in March of 2009?
The day before the market bottoms.
All right.
This goes out on Yahoo. It gets picked up by the New York Times and the Wall Street Journal. And at the time, the partners I'm working for are not happy when I would go on TV and say, look, that timing was just dumb luck. You could ask me the same question a month earlier.
You're a genius.
A month later, no, nobody really knows exactly. Hey, listen, there's a reason we don't sling $4.5 billion around on my gut. To this day, I can't tell you genius or lucky, maybe 80-20, like 80% lucky and a little bit of smarts.
All right, we'll take it.
But certainly not a reliable process to manage actual money with.
All right, so let's advance this story because they need the studio, and we're only in 2009.
Right.
So
that's it. That's the end of the story.
Yeah, but wait a second.
The fire hose of money starts coming in.
Yeah.
I hired Josh.
How'd you meet him?
At Lindsay in Coronado, California.
Okay.
Two New Yorkers sitting in the drizzle by the pool because I thought San Diego weather was supposed to be so great. He had been reading me for a while. I had found his blog and found him very amusing. And I'm like, so what are you doing on the sell side? I don't really see you as that sort of guy. He's like, I'm kind of miserable, not happy with it. I'd love to get on the buy side. What do I need to do? I'm like, do you have enough of a book of business that you could live off of while we actually build some clients and some assets? And he's like, it's a step back, but yeah. So came back to New York. At the time, I'm working for a shop called Fusion, was a shop after Maxim Group, which was I was working in the quant group that had created a software program that combined fundamentals and technicals and actually was not a bad product. And following, what had taken place, money is just.
But how is it that you moved from analysis, research into wealth management, essentially, where you're all of a sudden, clearly you've hooked into behavioral finance. You understand that people are their own worst enemies, that we're filled with various biases that kind of limit us.
Right.
So what I guess I'm trying to understand is
the transition. Like
what gets you to a place where you're like, okay, money, you could have just been slinging stocks with these people. You could have done anything. And you chose to take a more holistic approach to the client. How did that happen?
Well, it kind of easily because, first of all, I had spent a good chunk of the past decade writing about don't do this and don't do that. And here's the data on stock selection and how bad people are. And I'm not talking about amateurs. Here's the data on the professional between CRISP and DFA, and go down the list of all the research that's out there, and Vanguard. And there's a ton of research that says net of fees after 10 years, it's 98% of managers are underperforming. They're not earning their fees. And that's in like the pre-financial crisis. It got even worse from like 09 to 2020. Active managers did extra poorly. And so it was always, I didn't wake up one day and say, I want to be a wealth manager.
Right.
I woke up every day and said, Wall Street just does this wrong. The brokerage, listen, your lawyer is a fiduciary. Your accountant is a fiduciary. Your doctor has certain fiduciary obligations to you. Why does the person who manages your money have the same obligation to you as a used car salesman? That doesn't make any sense.
No.
And way early on, it was pretty clear that the fiduciary was the only right way to do it. Like when I was in law school and took and passed the bar, like I read all the ethic rules. I understand conflicts of interest and what is and is not the right way to do these things.
And yet this industry is so powerful. And full disclosure about like that I have a wife who works in the industry and is part of it. And the fight I used to have is around suitability is nothing. I could tell you something is suitable for you. I could say, hey, use that 529 plan.
By the way, who came up with the suitability side? What's the organization? Oh, wait, it's FINRA, formerly NESD,
right,
which is the self-regulated organization that the brokerage firms own.
Exactly.
Who would have ever guessed that their suitability standard is nonsense and designed to maximize profitability for the big wirehouse?
What I never understood in that process was I had interviewed a very big-time CEO of a large company, and it was right after the financial crisis. I said, let me ask you a question. Why don't you just blast the airwaves and say, we're all fiduciary all the time? That's what we're going to do. And get out in front of this because it's going to happen. I thought it was going to happen sooner, to be honest with you. I really did. I really did. I mean, I was so naive. But, and the answer was we'd cannibalize our own business.
Right. Which is very difficult I give Apple a lot of credit for building their iPod into the iPhone because they destroyed what was a very successful music player business. But in the long run, it worked out. I'm with you. For 20 years, I didn't understand how the brokerage business survived. I've been predicting their downfall. They've kind of partially adapted. They figured out, hey, if we're fiduciaries and we're just, putting together a long-term portfolio, our compliance costs go down, our litigation costs go down. It's so much better, and the trade-offs are just so much easier. But anyway, it was never, I want to do this as a business. In fact, I give Josh credit for saying to me, so all this money's coming in 09, 10, 11. He's like, dude, do you have any idea how hard it is to raise money? Why are you turning down cash or letting the firm give it to other people? And the process, so I was working with the investment committee, which was 2 guys there, and constantly butting heads with them. Why are you doing this? Didn't you just buy that? You bought this for a reason. That reason went away. Why do you still have that? It was like an exercise in learning how not to manage money. And so when Josh said, why don't you just keep these clients for yourself? And I said, all I want to do is write research and commentary and manage the portfolio. I don't want to deal with the back office stuff. I don't want to deal with the client headaches. I don't want to deal with all the crap that goes into running, the unfun part about running a firm. And he's like, I'll do that. I'm like, okay, let's start taking money in.
Okay.
And so it took us about a year to get pretty close to $100 million.
Right.
We launched in September of 2013. And the next 10 years, we've just,
pretty good.
Yeah.
So far, so good.
Now you're all caught up.
All right. Now let me ask you something. You're the CIO of the firm still.
Right.
You guys don't manage portfolios in a uniform way. In other words,
what do you mean? I think we do.
No, I'm just asking this question. I should. There's a question mark coming. But in other words, every advisor, how do they? What is their analysis? They say, do you have a conservative portfolio, a balanced portfolio? Like, how are you managing money?
First, we learn never to ask people, do you want an aggressive or conservative portfolio? Because the pushback you get has nothing to do with their risk tolerance or their goals. I'm not a conservative. I'm not aggressive. It's like, all right, so return is a function of how much risk you assume.
Right.
Right? And risk essentially means the range of possible outcomes up to and including your expected returns, but also the returns, here's the dispersion. You may be minus 20%. You might be plus 20%. That's what risk is. You don't know what that outcome is going to be. It's a defined set of parameters, but we don't know exactly what it is. Here's the probabilities. Here's the history. And if you, the longer the timeline, the narrower that dispersion of potential outcomes become. There's still risk involved. Otherwise, riskless. If you want riskless returns, you have to buy a U.S. Treasury. Right. That's it. So any return that's generated involves some form of risk. When we have advisors put together a financial plan, figure out people's financial goals, understand their ability to deal with market volatility, and we try and educate, hey, 1 out of every 4 years, you should expect the market to be down. That's what history says. And 1 out of every 10 years, you should expect it to be down substantially. Here's what it looks like 2 years, 5 years, 10 years, 20 years. So we create a series of different types of portfolios.
Okay.
The core portfolio is this much equity and this much bond.
And what do you use inside of those? Do you use ETFs? Do you use do you take big futures positions? Do you have separately managed accounts? Like, how did they work?
On the 401k side, it's all mutual funds.
Yep.
On the non-401k side, the preference is for ETFs.
Yep.
Because of their inherent tax efficiency and a lack of phantom taxes. If we have people who are dealing with substantial capital gains, inherited stock, sale of a business, sometimes just sale of a house, or a startup company, we've been using custom indexing through Canvas, now part of Franklin Templeton, previously part of O'Shaughnessy, which is now part of Franklin Templeton. And that essentially uses the core portfolios, but instead of holding 10 ETFs, you'll hold 800 stocks, the average positions of those 10 ETFs, and that allows a whole lot more efficient tax loss harvesting to offset the capital gains.
What do you think people don't understand when they think about investment management? What do you think? You've been doing this now for 3 decades. What is the core principle that you think would, that you really want to tell people, like, here's what you don't get. and it can be the simplest thing,
right?
And it can be a sophisticated thing. What don't we get as individuals?
We only have 10 minutes left. This is a long conversation. All right. In bullet points.
Just do one first.
Well, the biggest, the easiest, the most obvious is the single biggest obstacle to your successful investing is your behavior. I mean, it's easy.
Is a TikTok camera on? We can just put that on. Okay, sorry.
Right? Yeah. I mean, stop and think about it. Markets bottom when enough people panic, sell out. The statistics are 2 years after a capitulation, maybe it's 5 years, but it's some substantial period after a big market bottom, 30% of investors have not returned to equities. And from our experience, we had a ton of email. Hey, when you said in January 2008 you were 100% cash other than the short positions, which, by the way, we don't do here, but at the institutional firm we could. I followed you out on the market. I thought that was right. But in March 2009, when you said cover your shorts and go long, I didn't believe you that NASDAQ down whatever it was, 75%, the S&P down 57% was a good entry. And in 2012, 13, 14, we were getting emails, even 2015. I followed you out of the market. I thought you were crazy when you went back in. I'm still sitting in cash.
Okay, so you are your own worst enemy.
100%.
Number two.
It's a little corny. It's sort of, and I could limit this to 3, or I could keep going.
I like 3. I'm a network news girl. We do 3s.
All right. So the second one is, I wrote a column, I want to say it's 2015 or 16 for Bloomberg.
Mm-hmm.
I'm a big William Goldman fan. Someone had given me for my birthday Adventures in the Screen Trade. I read it a long time ago. And the quote that just leapt out of that book that I wrote a column on almost 10 years ago was nobody knows anything.
I love it.
And in the book he talks about Star Wars couldn't get made. All the studios passed on it. Raiders of the Lost Ark, no one wanted. No one wanted E.T. Like the list goes on and on. And the caveat quote to that is Paul Graham, who said, experts are experts in the way the world used to be. Trying to predict public taste for a film 5 years hence, from the time it's greenlighted to opening day, it's impossible. But the same thing is so true and is so humbling, and I think people don't realize how much humility is involved in being a good investor. You have to admit you don't know a whole lot more than you do know. You don't know when the Fed's going to cut. You don't know what non-farm payroll is going to be this weekend. You don't know where the market's going to be a year from now. You don't know who's going to win the AI race, just like you didn't know who was going to win the internet race, just like you didn't know who was going to win the computer race before that. It's incredibly humbling to say most of the things happening that are going to happen, we don't know, but we will humbly build a portfolio that's robust enough to withstand all of these outcomes, this range of outcomes. Right? Or more accurately, this range of outcomes. As opposed to making a bet on this, and you're either right or wrong. The people who do that successfully over time, and we know their names because they're so few and far between. There's a Michael Jordan and a LeBron James and a handful of other people. Maybe Caitlin Clark. The Warren Buffetts and the Peter Lynch's and the handful. Yep. But they're the exceptions that prove the rule. There are a few dozen, maybe 100 fund managers that have, like Peter Lynch, to his credit, after 13 years, he tapped out and said, I'm done. Right. I'm never going to be able to beat this. And I think everybody loves to listen to Peter Lynch and they love to pay attention to Warren Buffett. They ignore everything they say. They ignore how hard
I love when Warren Buffett had that one letter where he said, I told my heirs to put 90% of their money in the S&P 500 index and 10% in T-bills. Yeah. That's what I told them to do. I mean, good enough for Warren Buffett's heirs, good enough for me. You're your own worst enemy. Nobody knows anything. What's number 3?
I have to choose between number 3. This is really from like 5 or 10. So let's go with Hemingway. Okay. Gradually, then suddenly. So
say more about that.
So in one of The Sun Also Rises, I think that's the book.
Mm-hmm.
Someone asked someone how they went bankrupt,
Ah.
and the answer is gradually and then suddenly, gradually
Mm-hmm.
then all at once.
Mm-hmm.
And I told the story about I'm not a Corvette guy,
Mm-hmm.
but the C2 Corvette from 1963 to 1967. Probably the most beautiful car America has ever produced. As nice as anything out of Europe, any of the German or the Italian cars. Spectacular. It's a work of art. It's a rolling sculpture. And a couple of years ago, I got to spend an afternoon in somebody else's. And you just forget. So first of all, it's not a 3-part harness. It's just a lap belt.
Yeah.
There is no passenger mirror. It's not that it fell off. They just didn't think it was important. The brakes are like you're stopping a 1940s truck. The steering is like, it's like you have to be Popeye to.
Mm-hmm.
And it's the only thing it had going for it, aside from its beauty, was this big, gorgeous 300 plus horsepower engine, or if you got the 427, it's a 400 horsepower engine in 1967. Just ridiculous. But it drives like a piece of crap. And then you get into a modern car, and I have a 3D camera showing me exactly where I am pulling into a stop. The car will automatically stop if I'm going to plow into someone in front of me. The steering is light. The seats are air conditioned. Like everything. You just don't realize the effects of gradual incremental change over time. In automobiles, it's safety, luxury, convenience, speed.
Yeah.
In the market, it's the power of compounding.
Yeah.
And how long money adds up onto money. It's gradually and then all at once. My favorite example of this, there are a bunch of like really idiotic memes. A lot of what I write is disproving really stupid nonsense on Twitter or TikTok or wherever. Your money is lost over the last century. Your money has lost 96% of its value.
Whatever.
What do you think? A dollar bill is a store of value for a century? Your money has to hold its value from the time you earn it till you spend it, invest it, or pay your taxes with it. It's a medium of exchange. It's not a long-term store of value. And my favorite example of gradually then suddenly is two guys go off to World War II. One takes $1,000, buries it in his backyard in a mason jar. The other guy puts it in the market. 100 years later, the family of the guy who buried it in the mason jar finds it. To be fair to that idiotic meme, those $1,000 have lost 96% of their purchase powers because the dollar was not designed to be buried in a backyard for 100 years. The guy who invested it in the stock market for a century, what do you think that $1,000 turned into?
Oh my God, hundreds and millions, and
when I tell people over $30 million,
it's amazing.
They don't believe me. 1,000? What are you?
Run the numbers.
Rule of 72, 1,000, 2,000, 4, 8, 6. Go through it. It takes, by 2017, it's $32 million.
Okay, we're ready?
Gradually, all at once.
Okay, I got my 3. I need a lightning round here, so.
Fire away.
What did your mom teach you that's the most important thing? Like, what is it that your mom brought to you that is in your DNA that makes you who you are?
There's a lot of different things.
Pick one.
Be true to yourself.
Okay.
You can't, like first of all, she's the one who talked me into law school. And then when I left the practice of law and went to finance, and I was really expecting, Jewish mom, leaving law, this is going to be a problem. And to my great surprise, she's like, if this is what you think you were made to do, go do it.
Okay.
So very encouraging.
Your
true
father.
to yourself.
What about your father?
That was easy. That was really easy. Another great quote. I think this is Emerson. I can't hear what you're saying because what you're doing speaks so loudly. Right? What a great quote that is. And I've been using that lately with consumer sentiment. Yep. Oh, the world is coming to an end. Record sale of boats, record sale of travel. What you do speaks so loudly. Your words, especially when your words don't match your actions. And by the way, I'm chairman of the firm. I run the investment committee. your actions, your behavior is an important part of leadership. How many leaders say one thing and do something
Too many.
else? And so that is I hear my dad in my head, and neither of them are with us anymore, but I hear what you do speaks so loudly. I can't hear what you're saying.
What about your wife? How do you think that, like, how she's watched your ride? She knows the ups, the downs, all the different pieces. And she's a teacher. You said she was a teacher.
Right. Now retired.
Now retired. Thank God. Thank you, New York State pension system.
That's right.
What do you think she has given you that has changed the way you look at the world? Besides her love, which I'm sure is there.
I don't know if I would say, well, she's made me a little self-aware, which, I tend to be a little more oblivious about kind of walking through life, lost in whatever I'm thinking about. But she is the one who, very stable, steady job. She's the one who said, go for it. Anytime I said, I want to do this, I want to try that, I'm thinking of this, like, she's the first person that's like, go ahead. What's the worst that happens? You fall on your face. You want to launch a blog? Launch a blog. You want to launch a podcast? Launch a podcast. You want to launch a firm? Launch a firm. The worst that happens is you just completely and totally fail, and you pick yourself up, you dust yourself off, and you start over. I don't know how many people get that sort of support from a spouse, but I remember the four of us, me, Mike, Josh, Chris, sitting in the conference room in the old office, talking about launching Ritholtz Wealth Management. And, everybody was enthusiastic but nervous. And Batnick said to me, I'm a little concerned because you're not really that nervous. And I think that was my wife's voice in my head. Hey, the worst thing that can happen is you fail catastrophically. That's the worst thing. You pick yourself up. It's not failing. It's the resilience to get up and try again. And I think that's a great life lesson for people, but a great lesson for any entrepreneur. Your assumption has to be, you're not going to hit a home run the first time. You're going to fail. You better learn how to deal with that.
So I want to end by just saying, I think the first time I interviewed you was when I was early on at CBS. I interviewed you for something, or maybe you came into this. I can't remember. But
this has got to be like a decade plus ago,
at least,
right?
because I started at CBS in 15 years ago, 2009. Right. So I'm pretty sure that we interviewed you and did something for you when we were launching Money Watch, and you were very kind and you did something. And then
I remember that.
And then I remember that I interviewed you for AARP for a big piece we were doing. And I can't remember what that was. It might have been a pandemic piece. It might have been something else.
No, I think that's much older.
It might even be a financial crisis piece. But I have always admired the career that you've built. And I sort of feel in a weird way, like when I met Josh and Michael the first time, it would be as if I should have sent you a note at the time, which is like you send to a parent and you say, your children are so wonderful. You've done such a beautiful job. And I know that they are their own people and they came in as adults, but I cannot tell you the instant connection that I felt with these two men. And I think that is a reflection of the environment that you created, the firm that you built, and who you are. So I really want to thank you for that. I think this is like a great gift. It's like a shidduch that we're here together.
I'm going to share a story with you. It's the end of the podcast, so he's not going to yell at me for sharing this. Josh's first book comes out, and there's a book party, and his dad gives a toast. And at the end of the toast, he says, Barry, he's your problem now. And I just thought that, I was like, what does he mean by that?
Yeah.
I found out. But, I think all of us, the reason we gel, the reason the firm has the culture it has, the reason everybody gets along as well as they do, is we're all working towards the same goal. Like, there aren't separate agendas. We want to, we have a bizarre business model, right? And I try and explain this to people, and they're like, no, that doesn't make sense. Our business model is simply this. Hey, you can do this yourself. You have to manage your behavior. You have to have a little bit of interest. It doesn't take that much time. And if you do ABC and don't do XYZ, you can absolutely manage your own money. You could do it low cost. You don't have to pay any fees. You could do it yourself. Oh, and by the way, for those of you who don't want to do it yourself or don't have the patience or don't, reach out to us. We're happy to
yep.
We're happy to manage your money for a modest fee. And I would love to say that was a purposeful design. It's just everybody here is an educator, right? So I am, Josh is, Batnick, Ben Carlson. Nick certainly has become one. Tony and Dina Isola, literally teachers who became finance people and work with a lot of teachers and others. Everybody has this knowledge, and we are just compelled to share it with everybody. And you can do this yourself. And for the 0.001 of you that don't want to do it yourself, okay, we have this little shop over here, RWM. Feel free to reach out to us. I'd love to say that was a genius by design.
That's okay. You get there where you get there, right?
It kind of just happened and evolved over time, and thank goodness for it. As long as people want us to do this, we're gonna keep doing it.
Last. So you're a Long Island guy. Are you an Islander fan?
I'm a basketball fan, not a hockey fan.
All right. I was gonna throw out an Islander reference, which is instead of saying thank God, I would have said thank Bossy.
There you go. So what you could have said was this was the first year where the New York Knicks actually looked like a team in 20 plus
Absolutely.
years.
So
that was to me. I am not a good skater, but I have a pretty good outside shot. So that's why
really? So we'll have
basketball is more interesting.
So maybe at some point in the future, someday next year on the South Shore. We
have a big barbecue.
All right.
Well,
get
now
me
those
invited.
guys are on the South Shore.
You're on the North Shore.
I'm on the North Shore.
That's okay.
Because
I'm a 495 kind of gal. I'm on that road all the time.
You go north or south, doesn't matter.
I go straight out. Right. I only go east. That's where I go. So I would love to show you that I actually have some game.
Okay.
As you can see, I was either going to be a piano player or a power forward.
Right.
And delighted.
You're like 6'1"?
No, I love that you said that. I was 5'11". I think I'm 5'10"-ish now.
Right.
I'm shrinking because I'm an old
lady.
lady.
That's not, even in the women's game, that's not a power forward.
No, I used to be.
Right.
And
there were women with 6'6", 6'8".
Dude, let me just tell you that when I used to say to people, how am I going to know? I said, I'm the tallest Jewish girl you've ever met.
Right.
That's usually, they spotted me immediately.
You also should be aware that, and I played volleyball all summer on Fire Island in college and grad school. Fire Island, like collegiate volleyball, you're a credible player at 5'11", 6 foot.
Yeah. Well, I don't know. Wasn't my game. Barry Ritholtz. Thank you so much. It is a supreme honor, pleasure, and delight to be adjacent to the Ritholtz family through the Compound Media programs.
Well, thank you so much for having me. I've been looking forward to this, and you're always just so easy to talk to.
This is delightful.
It's a delight being on this side.
It's very nice. Hey, gang, thanks so much for watching. If you've got any questions, you can go to JillOnMoney.com, click the Contact Us button. We love you. We'll see you next time.